morning, everyone. Happy Thursday to all. Welcome to another webinar here hosted by Affinity Management Services. We're very excited to have you here today. A big topic that we have going on, especially for our condo associations having to deal with budgets. Today, we're going over budgeting strategies for a well-run community. So the topic today, we're going to be talking about how we can have effective management is because it's the cornerstone of any thriving community. In order to ensure the physical well-being of an association, it's essential to take a series of smart budgeting decisions that keep your community on track. So today we're going to have Marc Landes from Haber helping us navigate through these difficult waters. And we'll also have the COO of Affinity Management, Pedro Garcia, here with us today. So we're very excited. And prior to getting started, why don't we do some introductions? Marc, if you could say a few words about yourself and the firm.
Absolutely. Name's Marc Landes, CPA. I am a principal over at Hafer. Hafer's been around for 45 years. We do audits, reviews, compilations, as well as tax returns for associations. And that's pretty much our niche.
Well, thank you so much for joining us. I know you and I have been nonstop. It's like we're on a road show. Yesterday, we had a board certification course. Last week, we did another course. So I'm excited again for you joining us here today.
Definitely.
Next up, we have Pedro. Pedro, want to say a little bit about yourself and obviously about being a co-founder here at Affinity.
Thank you so much for putting it together, Rolf. I mean, don't know if there's a lot to say. I know you've been on the air a lot. A lot of people have gotten to know a lot about Affinity. One of the things that kind of makes us unique and the approach that we take to running the operations for our clients is really pushing what we call the AED product. So that's the alignment, execute, and deliver. We try to bring together a really strong alignment for all operational issues, financial issues, legal issues, and really try to understand the client as well as we can and execute real solutions that they can really sort of benefit from. And most of the time, we're able to deliver in a way that guarantees results for the client. So it's part of our culture of accountability. And, that's really sort of my role in the organization to make sure our team is really working hard for every client.
Excellent. Well, thank you so much for joining us here today, Pedro. As Pedro mentioned, here at Affinity, we're dedicated to empowering you with knowledge that's needed to make an informed decision. We know that this year in particular has come with many challenges, especially for our condo associations. But ultimately, we try to look at things in a positive light. While this is a difficult time, the benefits of having these requirements are going to allow our board members to really make the right decision for our communities, which is safety is always of high priority. So having the money to be able to do the structural repairs and the necessary repairs that these condo associations have are important. And I definitely don't want to leave out our HOAs because our HOAs have had to deal with their own challenges as well, with increases in insurance costs, increases in labor costs. So it's a plethora of challenges, but ultimately what we're here to do is when you're working with the right professionals, they can guide you and walk you through these challenges. So let's get back on topic here, talking about budgets and finances. So I'll start with you, Marc. I know being a CPA, you do a great job there at Hafer in order to build relationships with your clients, understand the challenges that they're going and really helping them navigate through it. So I think it's only fitting that we start off with, what have been some of the common mistakes that you've been seeing when in dealing with these budgets, and what are some of the steps that board members as well as managers that are on this video call today that they can try to avoid for those that haven't passed the budget yet?
Sure. I think one of the biggest problems is, the Joneses effect, keeping up with the Joneses. A lot of people will say when they're putting together a budget, well, what do our neighbors pay? As far as their assessment. So they'll start off by saying, all right, well, $500 a month is what our neighbors are paying. We should pay that as well. Not considering square footage, not considering units, not considering actual costs. So what will happen is you'll see a number gets put in on top and it doesn't really reflect ultimately what should be put in the top number as far as what the assessments are paid. So what happens from that point on is you see some gerrymandering. as far as putting in the costs on the lower levels of the budget. What we always recommend is building up a budget from the bottom up. A bottom up approach is putting in real numbers, putting in real estimates, putting a thought process, trying to mark up all of the lines so that you know why you put those numbers in. And, that's best practice. I can say that a lot of associations that they're competing with their neighbors on assessment price, ultimately they're going to lose because, people look at the building and the value. People are also more than ever looking at special assessments. That's a good indicator of whether the board is doing their due diligence sometimes. But as you're well aware, with current situations, in some cases, it's not easily something that we can get rid of a special assessment. Insurance is out of control the last couple years in some cases, especially for coastal properties. But most associations and most people who are getting into a condominium now, or even an HOA, these are the questions that they're asking. What's the special assessment look like? What's the assessments look like? How well funded are the reserves? We're just seeing a lot more sophisticated questions, especially when we're doing these audits now.
Excellent. And I know, as we opened, I know I've always liked the way that you approach it and how you're open and honest with the client, because I know it's very difficult for us at times when we're making certain recommendations of, your budgets need to go up a certain percentage point. And this is what we're seeing in the market with, the years of experience that we have. And it becomes a little bit of a challenge, right? Because we understand the board's perspective where, sometimes they run on trying to keep maintenance fees low, which we definitely don't agree with that. But ultimately, they're their neighbors and they're trying to do what's best for them. So it's important to bring in partners such as yourself to have those conversations. So, Pedro, I want to bring you into it. I know, I guess from a boots on the ground perspective, what have you seen? And if we can maybe break it down from HOAs and condos, because I know our experience has been pretty different depending on the segmentation. So talk to me a little bit about what you've experienced, maybe what are the average percentages? I know, as Marc mentioned, everyone's different, but everyone at the end of the day does want to keep up with the Joneses. So tell us a little bit about that.
Yeah. So at a foundational level, I think that whether you're an HOA or a condo, just going into, I guess, the civic service of being a board member, a lot of times there is this mentality that going along the same thread of what Marc said. I don't call it keep it with the Joneses, but it's more or less the same principle, is that there is this misperception that the board member's job is to keep the fees the same or roll them back. That is a mindset, an erosive or corrosive mentality that drives a lack of productivity, lack of solutions, and just overall a lack of proper financial planning for the association. And that is the foundational problem that we see, regardless of what type of association we're dealing with. On both sides, both condo and HOAs, we have seen across the board that anything that's impacted by inflationary costs, such as labor, and things have gone up in cost since the pandemic. You'll see this in landscaping, front desk services, all these sort of entry level positions that usually people walk into, sort of the lower end blue collar work. Those have risen a lot. I mean, pre-pandemic, you can hire someone front desk or to cut the grass for maybe minimum wage at $12 an hour. Nowadays, it's $15 to $20 an hour. So that has a massive inflationary effect on most of the contracted services that normally people don't think much about because it's just it's just supposed to happen. More so on the condo side than on the HOA side. It doesn't mean that HOAs haven't been impacted, but more so on the condo side. We all know insurance has skyrocketed, and that is not a dramatic word by any stretch of the imagination. We've seen clients pay 100% more insurance, and that obviously depends on the location. If you're closer to the water or an impact zone, flood zone, whatever, you're going to get more of those increases, and that has, over the past year and prior years, it has already taken effect, and we've tried to bake it in to every budget, but that has had a massive impact. The next one that affects more the condos than the HOAs is obviously the component of reserves. We all know about the SIRS at this point, the Structural Integrity Reserve Study. Historically, it's been the issue of also the non-structural reserve components, but now we're all sort of mandated by law to abide by the reserve requirements, and that has had a very large effect on moving forward what we expect the increase will be. In a lot of cases, it's a big increase, but also coupled with a big special assessment for the client, because they need to sort of deal with the deficit or deal with the catch up that the structural report has outlined. So where we do see the biggest changes and where we see the biggest mistakes is a lack of preparation going into it, because they feel like they can control the cost and they can control the situation. So that lack of acceptance has led to either a procrastination or just maybe not really educating the residents correctly. And as a result, it does lead to a situation where it's usually not a healthy option for them. But the biggest increases are that insurance and reserve for condos. And on the HOA side, there's not that much of an increase, maybe 10-15% usually, and it's usually inflationary costs related to labor on landscaping and things like that.
Great points there. Now I do want to bring you in, Mark, because I know we were talking about it a little bit yesterday during our board certification course that we were doing together, which really had to do with how these structural integrity reserves are being incorporated into the budgets, and more importantly, the legal requirements of ensuring that they're being properly funded. So I know if you could talk a little bit about the differences. I know we spoke a bit about the pooling, the way that these need to be structured within the budget. So maybe from your perspective, how have you seen that these are being structured, or what are the best practices?
I'd say most associations that we're seeing right now have either gotten their reserve study done, or they're just about to get theirs. Most associations already preparing to some extent, as far as paying towards it. When it comes to pooled, I can say this, that a lot of associations, need to understand that this pooled method has to be updated every year. That's one of the biggest common mistakes that I've seen. You can't just take something from 10 years ago and apply it to now. Definitely there's some changes. I always say that it's worth a conversation with your specialist to get this updated annually if you have pooled. It definitely does drain the resources of an association's manager if they're going to put together this multi-level, multi-column Excel spreadsheet. I've had situations where it's done incorrectly by a CAM, submitted incorrectly. Sometimes a CAM won't even understand the difference between component and a pooled reserve, and they'll submit a component-based reserve, and then the DVPR will come in and get involved because this is incorrect. So I'd say this for most associations, that they understand that this is the last year that they can waive or partially fund structural. A lot of them are not doing this, with the exception of some of the smaller ones that we talked about today and yesterday. Before the presentation, I mentioned, a lot of these small 50 unit associations, they're struggling to make it up for it, because in some cases they haven't paid anything in years. But for the most part, I would say component is the easier to put together, but when it comes to pooled, make sure that you have that multi-column paper affixed to your budget, because it's definitely something the state will hit a lot of associations with.
Correct. Yeah. I recall you mentioning that yesterday. And again, it just goes to reflect the importance of working with your partners early on. That way that, you're avoiding any potential challenges in the near future. And I did forget to mention in opening the conversation, or the webinar, I should say, for those listeners, managers, or board members, we do have the Q&A available. So if you have any questions related to the topics, feel free to put them in there, and Mark, Pedro, or myself will do our best to get to them. So going back to it, Mark, I mean, it is important, and, to have those conversations earlier on with the CPA, rather than waiting into the audit, the review or compilation, whatever it is that you're interacting with the CPA, because that will get things moving in the right direction. And again, you can't expect the CAM to know it all when it comes to how to set certain structures up, especially within the budget. So wherever they're lacking, that's where the importance of working with a partner is important. One thing I do want to highlight as well for those condo boards, because there's still that understanding that, well, I have my structural, so I don't have to vote down any other reserves. It's important to understand that the structural components do not cover all of the items within your association. So those items that don't fall within the structural integrity reserves, you still have a responsibility to hold a owners meeting to vote down those components. In many cases, what we have found is that it's so minimal that it's just not even makes sense to go through that process. But it really depends on your association and how it's structured. Because if you have spas and things of that nature, then it may be significantly more, so that you may still need to make a decision if you're going to waive those items. So speaking of that, Pedro, I want to bring you into the conversation here because, we're always trying to, at least from the management side, always trying to balance between, short-term, long-term financial planning, with reserve funding, even if it's for HOAs or condos, the challenges are with capital improvements. So talk to me a little bit about how to guide and possibly set expectations. Let's look at it from both perspectives, from those associations that have already approved the budget. What are the next steps? Because once you approve it, you're not done. And those that maybe are in the final stages that still have some time to maybe make some last minute changes.
Yeah, yeah. So Um, I think when we talk about long-term planning and major costs like reserves, capital improvements, we're talking about big dollars, and anything in the future or anything that's big in nature, I think that any book you read, anywhere you read, it always talks about having a solid vision. So you want to make sure you have a solid vision of that. Usually, what that looks like in sort of like a more tangible way is you want to have a document, in this case, either reserve study or the structural reserve study, or whatever the project estimates are. So we are clear and we're all talking about apples to apples. What are we really talking about? What's the number? What are the details? And this way, the communication really goes through a lot easier and the solution process goes a lot easier as well. Once you understand whatever that number is, whether it's a project, a reserve, contribution, or whatever, I think the best thing to do is really to, as you said, work with the partners. You have to have the CPA, the attorney, and the reserve specialist or engineer, if it's a project, involved in the conversation so that you can actually bring it all together. Is it right to do a special assessment? Is it right to get a loan? Very often, a lot of associations leave behind the option of financing and funding some of these things through a financing option. And there's a lot of great banking partners out there that will help with that. The other part of that as well, besides the loan and special assessment, is if the impact is not so much and you've gone through a proper educational sort of town hall discussion with your residents, in most cases, residents will understand so long as you talk to them. And in a lot of cases, they're okay with just doing the operational increase or baking it into the budget. But it all depends on the amount of the increase, the demographic of your residents, and the amount of work that's been put in to really bring them into the conversation and to really educate them on what is truly happening with the association. So one thing that I often very much see that sort of gets missed during this whole budgeting process is understanding the actual liquidity of the association. Everybody always talks about income and expenses because that's the way the budget is built, income and expenses. Very often, there is either a risk or an opportunity missed if you do not look at your current assets and your current liabilities. If you compare those, and your CPA will tell you, you should have a 2-month benchmark approximately. That's the ideal of working capital. And if you compare those, in a lot of cases with our clients, they have a surplus and they're able to transfer some of those surplus monies into reserves or spending on our project that they've been wanting to do. In other cases, very few in our case, but they have less than they should, and they're able to now to see clearly, okay, now we have to address that, but it doesn't catch them by surprise. So the budgeting process needs to include, for short-term and long-term planning, a proper liquidity analysis to really make sure we know where the association really is in terms of its cash position.
Yeah, those are definitely excellent points. I know that we're always trying to get to those 2 months. Mark, in your experience dealing with so many associations, what do you see? Do you see it kind of all over the place, or are you seeing things getting a little bit better? What's your take on that 2 months and having to manage those long and short-term projects?
I'm glad Pedro brought it up because it's like going to confessional. You know, like I go into these meetings and I feel like I'm playing mediator because, like, you know, how well can a manager or a management company do if they don't have 2 months of working capital? I mean, that's the lifeblood of the association. You know, and you can see some associations want to be thin because, you know, they're just really exclusive associations. You know, a lot of really bigger, you know, masters, sometimes they'll only have 1%, but you can see it in the faces of the manager that they're moving money around as needed. And, you know, like they will appreciate if it's closer to two because they don't have to move money around. They don't have to juggle this amount of bookkeeping that needs to be done. You know, I see so many associations that, you know, they're not high revenue associations. They're mid level. You know, sometimes these associations have 500,000 of assessments for the year. You can see that they're struggling,
Yeah.
and in some cases, you're seeing, you know, multiple special assessments just to get through a year. And that just shouldn't be the case, you know, and it just puts a tremendous amount of pressure for a management company and a CAM especially, you know, to keep a vendor on site, to keep things being paid. And, you know, if you know, this is causes burnout in the industry. So, you know, I always say, you know, to when I see these situations, I say something. You can see though, for multiple reasons, it might not be well received. You know, like I said, there's sometimes people are like, well, we can't increase assessments right now. We've already increased it up to 15%. We don't want to do more. And I'm hearing more and more often attorneys saying, yes, we know that, you know, the 15% rule used to apply, but, you know, if you have insurance that goes up 60% to 200% in a year, how can you apply these rules? So, you know, the responsibility is of the association to pay the bills. The responsibility is to not have vendors walk off. And the continuity it has to be there. I mean, nobody living in this association is going to be okay with certain amenities and certain common areas being shut down. You know, the idea is that, you know, everything is being paid on a timely basis and, you know, the common area is being well run.
Yeah, that's correct. And I love how you mentioned it of the load on the manager, because I can't tell you how many times when you're in a situation where yes, the intentions are there and they're good intentions by the board of moving projects along, but the reality is that, or the challenges is that they don't have the funds there available to move these things along. And when you're bringing it up, it's, you know, what you're doing is juggling, and all that creates is an operational load for the office, for the management team, for everyone around, because you're having to juggle the vendors, you're having to juggle the owners that whatever they may be upset, things are not moving at the speed that they would like them to move. And many times it has to do with the finances. I mean, that's why now when we're interviewing companies, as we spoke a little bit beforehand, is making sure that they have the necessary funds. Because if you have a great vision but you don't have money to be able to execute that vision, then it doesn't matter who you select, you won't be able to move those projects forward, and that's where the challenge comes. So I'll keep it here with you, Mark. I guess what have you seen when it comes to unexpected expenses, because they happen in associations. You know, you have an elevator, the hydraulic pump goes bad, or in an HOA where, you know, main line bursts that the association is responsible for. What have you seen, and what strategies have you advised your clients to help them in these difficult situations when these things occur?
I always tell a lot of my associations, look at the spillover costs, consider spillover costs. These are things that, you know, if you have a $2 billion special assessment and you have projects going on, sometimes concrete restoration, people don't think about the higher electric bills. When a pool is being redone, the last thing people think about is the water that it's going to take to refill a pool.
Yep.
Sometimes it's multiple pressure cleaning jobs that are going on, especially with paint. So, I often see that, they per the agreement with the structural component of it, they'll budget to the penny, or maybe even give 20%, but yet they have nothing for electricity. They have nothing for any other run over costs. So I think it's important when you're putting together a special assessment to consider, what's going to pay for that. Even if the financing, a lot of times you'll see financing as a component, and it goes onto the operating budget, and yet there's no component to deal with that. So what funds are being cannibalized at that point to pay for these, especially if that wasn't something that was special assessed for some type of financing. If it's not in the operating, and it's not in your special assessment, then it's basically getting eaten up by your operations. And another point of that, a lot of associations are like, yeah, Mark, we understand we need the answer to all these problems is money. And where does it come from? And just to play off of what Pedro said before, a revolving line of credit, financing, whatever it takes to get you where you need to be. I mentioned this yesterday when we were talking. One of the things that people don't even realize is your deductibles for your insurance were maybe 2% 6 years ago, maybe 10 years ago. A lot of associations are up to 10%. It could be from $500,000 change to sometimes $3 million over the course of these couple of years. And for a lot of associations, they can't raise a deductible very quickly. So I tell them, get a revolving line of credit for emergencies, for this purpose. And this is a way that if the worst case scenario happens, you're kind of self-insured with this revolving line of credit. You can get a vendor out there, you can get the work done. And that's something you can do while you're trying to build up your fund balance and get that working capital to that 2 times mark, as Pedro had mentioned before. I gotta say, the closer an association is to 1 times, or even under 1 times working capital, you can see it in the office. The manager's not happy, the admins underneath them are not happy. The amount of stress and managing the accounting becomes so much more, and it's already a very robust job. You've got to deal with people, you've got to deal with vendors, you've got to deal with staff. Now you've got to deal with the accounting and sit there with your visor and your 10 key and start 10 keying all the bills and holding checks. Sometimes that's just added pressure on already it's already a very difficult job to begin with.
Of course. And Pedro, I guess from boots on the ground, what have you seen? What are some of the best practices that could be applied in these kinds of instances?
So we try to follow sort of like a 4-point rule. One of them, Mark mentioned, which is a revolving line of credit. The next one is have a small contingency fund that kind of builds up over time. It's not a reserve fund, it's not a restricted fund, but it's just a contingency fund that some of our clients have actually elected to do. They set it aside for a rainy day fund, so to speak. The next thing is have that 2-month benchmark in your operating account. It's not just a sign of good health. It's a sign that you can take the blow of an unexpected expense in your operating account, and you don't have to be running around for the money. A small unexpected change to your expenses, that 2 months will really help. Lastly, and I think more fundamentally, what really helps deal with unexpected things is just to do proper budgeting from the beginning. Most of the time, it's not really unexpected. Someone must have and should have seen it coming, except no one wanted to really look at it because, again, they started out with the wrong mentality. They started out with, I don't want to increase the fees. If we start out with what Mark said originally, forget about the fees, forget about how much you're going to assess, really, truly, and honestly, and I say that emphatically, honestly, look at what it's going to cost to run the association properly. And properly means having the right quality of life for the residents. That's a fiduciary duty for the board. I mean, they actually have to make sure they're actually running the operations and governing in the right direction. So you want to really look at what the real cost is. Very often they start out with the wrong mentality, and very often the operations of an association get oversimplified or watered down to, well, the contract cost for the pool is just, X amount, and that's all. So, well, you're not counting into there the filter changes. How about if the pump breaks? Or how about if we have to drain the pool for some reason? And God knows what a bunch of things that can happen. And that's just one component. Landscaping, for example, you could have a storm. You have to do storm pickup or prep. So there has to be an honest assessment and evaluation of what the real operation looks like to really give the residents a proper quality of life and really run the operations without the unexpected, because it should be seen and it should be expected, except that we close ourselves off and we put the blinders on so that we can say, oh, we didn't do an increase this year. So proper budgeting is really at the fundamental of all this. You can have the 2 months, you can have the revolving line of credit, and you can have a contingency fund of some sort that can build up over time. But proper budgeting will be probably 80% of this to really get you there.
Excellent. And I think this leads me to my next question, which is a little bit of a volley here for you to slam dunk. Talk to me about the benefits of the reserve study and how they help influence some of those budgeting decisions.
Me or Mark?
Oh, go ahead, Pedro. Sorry, leaving you.
Okay, yeah, I didn't want to yeah. So the reserve study, whichever one we're talking about, whether it's the non-structural or the structural, I think what it does, it really adds a conversation piece that is factual in nature. It's not an opinion anymore. It's not one board member against the other. It's not management trying to play, wise compliance officer or whatever. It's really an independent professional telling us this is what it would take to properly plan for the future and comply with the current legal requirements. So it definitely becomes an undisputed document or piece of information that helps the conversation move along. And obviously, the numbers after that are sort of like just work themselves out. But more importantly, it really does help the conversation a lot to have that piece of information ahead of time so that you can talk to the residents, so that you can talk in the workshops, the budget workshops, and so you can do the proper planning with your CPA or with your management company.
And Mark, I want to bring you in, I guess, from your experience, because I know you guys do self-manage, obviously, communities as well. Have you seen the reserve study? Do you think the boards are utilizing them to the advantage that they can? And what are some tips, I guess, from the CPA side of having a tool like the reserve study?
I think it depends on, everything is all things considered. I've seen some situations where I say, look, have somebody non-biased come in there, set a standard of what it should be. There's some boards that, there's very little reserve expenses. So if they're sophisticated enough to question some of the reserve study, go ahead. That's working with your professionals to come up with the actual true numbers. I think where a lot of self-manage goes wrong is they don't have the revolving line of credit. They don't have, that cash cushion of 2 months of working capital. And then you have a storm that comes through and maybe you can't make your deductible. You don't have enough damages for that. And, maybe you have a deductible of $1.5 million. And, the other side of this is you have $750,000 worth of damages. The first thought is for most associations is, oh my God, my operating can't handle this. Let me go to the reserves and grab this. And the first thing I have to tell them is, this was not one of the components that you funded for. You have no funding that's reserve related to hurricane. You have usually nothing related to this type of landscaping. You can't use this for random debris. And a lot of associations are like freaking out and in this panic of what are we going to have to do to pay this? And then it comes down to setting up a special assessment. So I think the important thing is to understand what you're reserving for. If you want to at some point utilize your reserves for such things, then you have to set up a reserve for a storm. And people are like, well, that's not something statutorily permissible with condo, I say then you have non-statutory reserves that you're funding. And, you know, we'll recognize those and outline those in an audit that, yeah, these are voluntary reserves that you're utilizing for a storm, and we keep them separated so that they can be used for this specific purpose. You know, so there's different ways to handle this. I think it just comes down to having open conversations with the CPAs, having a conversation with the reserve specialists, and making sure that, you know, you do have a management company or somebody there to explain to you the rules for the day to day.
Correct. Yeah, and you do have some of these boards that are very prudent. Like we took a client up in Palm Beach area. They had their line of credit already lined up. It can't cover the entire deductible, but they were prudent in the steps that they took, you know, the necessary steps. At least they have something to kick off a project and not have to rush immediately to the owners. But yes, you bring up, it's difficult to really have everything in line. That's just a reality, especially with the percentage rates that where they are for most associations now. But ultimately, if you can check off as many boxes as possible, you'll find yourself in a much better position. So I do want to answer. Connie just dropped a question in the Q&A. Connie asked the question is, what do I need to do to weigh the structural integrity reserves for 2025? So I'll take that one. Connie, I would highly recommend that you have a conversation with your association attorney on the process to be able to do this. This is the last year that you can do it. However, there is a particular process that you must follow, so make sure you get an opinion from your association's attorney. What I do recommend as a professional tip is to make sure that if you're going to take that step and you're jumping all the hoops that you need to jump, is that at least you pass something. So if you're doing this because you don't have your structural integrity reserve number just yet, just round up 10% of what your budget is if you don't have reserves at the moment. You want to at least start warming up your residents to what they can expect. Additionally, if you're postponing this for next year, make sure that you're communicating with your residents of what you're doing, what steps you're following, so they're not blindsided come next year, assuming the case that you don't have any reserves, that all of a sudden you're going from, let's say, a $500 maintenance fee to an $800 maintenance fee. So my recommendation is get professional advice from the attorney, have them outline the process that you need to follow, and then that way, as a board member, you've followed the business judgment rule in what you need to do and how you need to do it. So
Ralph, if I can jump into
yeah,
that one really
sure.
quick, just 1 minute. With Connie and asking that's been a common question for our clients. Do we really have to do this? Can we delay it? We always recommend, let's just, you know, bite the bullet. Let's move forward. Let's get it done. You're gonna have to do it anyway. But if you're in a, you know, whatever spot you're in, which we don't fully understand, I echo Ralph's recommendation to get your attorney involved, but I would take it even further. I believe the attorney needs to provide a formal legal opinion letter, clearly explaining what your board member duties are and what flexibility or options you have to comply or defer this decision. More importantly, their office should prepare the notices and all the instruments or voting instruments that are needed, and they should also be present at the meeting. All of that will add a layer of transparency and legal compliance. Taking it a step further, again, Rafael mentioned this already, you should have all of that stuff, you should have it well documented in your association website. You should have that well communicated through a town hall meeting with your residents. Communication is extremely key in these very, very difficult decisions you have to make, whether you defer or not. But your professional partners, CPAs, attorneys, I cannot say enough how they have to be involved during this whole process. They have to be there, present, helping you out.
Okay, excellent. Good tips there. So Pedro, I want to leave it here back with you. Obviously, as associations are going through their budgets, whether passed or not passed, everything that we're seeing with the news, which the news does a great job of showing us all the wrong things that are happening within our industry, even though there's a lot of good things happening within our industry. Clickbait, right? Talk to me a little bit about how community association and boards in particular, and managers as well, because we do have many managers here, some of our own. How can they ensure transparency, and what steps? You brought up communication. let's talk a little bit about the communication. Like what are the steps that they should be doing now
Yeah,
that the budget has been approved or that is being approved and in the following years?
yeah. So I think the communication is key. And we kind of try to hit it in four ways. Number one, I'll go back to the prior question that we handled with Connie. Having your dedicated professional team is key. And I mean, a lot of board members are shy to pull the trigger on getting the attorney involved or the CPA involved because of the engagement fees or whatever the case may be. And again, it goes back to that mentality of not spending money or keeping the fees low or whatever the case may be. The reality, folks, is that you're running a not-for-profit. You're doing it at, basically volunteer, no pay, and you're making very big decisions for what sometimes is multi-million-dollar organizations. You will be held to account, and you are exposing yourself to risk and the association and your neighbors to risk if you're not actually following the right advice. So you need to not just get the advice from these professionals, but more importantly, you need them involved. You need the legal opinions to be in writing. You need them at the meetings to kind of handle questions by residents. There is no reason whatsoever why a board member or manager needs to be fielding FAQ sessions or questions from residents on legal matters. No reason whatsoever. The attorney should be present and they should be talking about all the compliance stuff and all the legal stuff. Same goes for the accounting stuff. If someone has a question about their audit and reserves and all of that, that's what the CPA is there for. And ultimately, they're really the ones that are well equipped and licensed for this type of activity. On the operational level, so that piece of having your professionals involved improves communication altogether because it's no longer board members against residents or management companies giving out a message that could or could not be wrong. So I think it's really having the experts. You need the experts involved on the communication piece. Secondly, regular communication with residents and with your board members. So that looks like a newsletter and a management report on a regular basis, whether it's weekly, bi-weekly, or monthly, depending on the rhythm of the operation. You need that regular rhythm of communication. The website piece is of the utmost, so no one can show up to a meeting and say, oh, I didn't know that you guys did this, or I didn't know that this was already out there. If you have it on the website, you're keeping it updated, the financials, the structural integrity reserves, like all that stuff, that needs to be up as soon as you get it so that no one can say, I didn't know. It's all there. So lastly, and this is not something that's done very much, but it depends on the situation, but regular town hall meetings with your residents. So I'm not talking about monthly, maybe a quarterly one will do, or every 6 months. That will really hit a nice pressure release valve on any tension, any misunderstandings, any misinformation that's building up in the community. Besides the newsletters and the website, if you just open up the mic for them to talk, let them ask their questions, you have the professionals present for them to answer those questions, that helps and goes a long, long way towards really bridging that communication piece with residents. Most of the time, it just takes someone with the competent knowledge to just explain things, and they'll go along with anything. But if no one's talking to them, that's when things start getting really tense politically and unnecessarily unproductive.
Yeah, the communication piece is definitely an important one, and I know it's that having to deal with the one or two, because there's always one or two in every association. But ultimately, if you're able to really communicate well, get the information out there, the rest will support you, and those one or two will hopefully start to silence themselves. So we're done with budgets now. Let's talk a little bit more, and I'll get you into this, Marc, because I know you're getting ready to start your busy season. I'm sure you're excited about it. Wink, wink. So, with everything that's going on with structural integrity reserves, I'm sure people's budgets are now going to start shooting into thresholds that they've never had. So I think it's important for us to communicate to those managers as well as board members of, what's the importance of these review, audit, compilation. Do they play a role in any way in the budgets? And talk to me a little bit about what the challenges you see for the coming year, especially similar to the engineers. You're going to have budgets that used to be at 400 that are now at 500 requiring that audit. Do you see our industry having the capacity to be able to maintain that number, that increase, as well as hit the deadlines that we have of that the statute provides and having those audits completed?
I gotta say, there's the last few years, it's been really difficult at all levels. Like the news has been reporting somewhere between 340,000 open positions in accounting, from clerks all the way up to high-level CPA positions, CFOs.
Mm-hmm.
And these are just positions that are unfulfilled in the United States. So you think about that, we're getting reports later than ever, than historical data that we have is showing us. And we're just seeing it's slower down the line. I'll say this, state of Florida proposed to extend the deadline from April 30th all the way out another 60 days. And the state said, let's not do this. We know a lot of associations are late, but we do not want to reward bad behavior and have people go out even later than they're supposed to. So there has been talk about, not enough accountants to get the work to the CPAs, not enough CPAs to do the work. These are just all known things. I gotta say, like 5 years ago in the industry, I think if you had more than 5 journal entries, that was a lot. Now we're seeing 13 is a lot. This is just, because of the lack of accountants, the lack of people taking on the tasks. Also, not only is there a lack of accountants, there's more work. We have to do so much more work with the reserves. I would assume that because of the special assessments, because of the increased reserves, because of the increased collection situations going on, that creates more work for most associations. And I hear it through people working at management companies. Yeah, we have these positions available. We have these positions available. AR has become a very stressful job. People complain about estoppels and all of these other things, but you got to think about it from the perspective of the management company. If you've got 6 or 7 special assessments going on, that just makes the estoppel that much harder to get on a decent amount of time to the clients, especially with the amount of risk that an estoppel entails. So, these are just all issues that we're seeing right now. With regards to the audits, I can say that next year is going to be a busy year. The reserves makes it that much more complicated.
Mm-hmm.
A lot of associations that didn't have an audit, they had maybe a compilation or maybe they had a review. Now they're going to need an audit because of the amount of work that's going into this. It's not so much the reserves being collected. That's not revenue. It's only revenue when it's spent. But we all know that, we had that recession, 2007, 2008. A lot of associations put these projects on the back burner for almost a decade and a half.
Yep.
And, this is part of the reason why costs are so high is you have all the associations that need all this work that have been putting it off for so many years. And then you have all of the new structures going up in South Florida. So it's a competition for the raw resources, whether it's people or whether it's physical resources like concrete and workers to work on the structural repairs that are needed.
Okay, great points. Yep. And it's interesting. I know we're always trying to, I tell you from the top, I'm always pushing. No, we don't want past the deadline, but we understand how difficult it is. Look at Pedro smiling over there. He knows I put that pressure. But yeah, I'm very interested to see how this year, I know we've experienced it from all sides, from all talent pools. It's been very challenging. Everyone's moving to South Florida, but it seems like there's still no one applying for certain positions, but we're working through it, right? So we're getting close to 10 minutes, and I want to make sure we're respectful of everyone's time here. So I want to get at least this one question, because Marc opened up a door that I definitely wanted to touch up. Obviously, we've been having some very strong years of success here in South Florida. We've had, property values in many instances have doubled since COVID. But not making a doomsday here, but in reality, I do think that every economy has its cycles, and it's only a matter of time before something happens. What that percentage is, nobody knows. I wish I could know, but there's definitely going to be some kind of correction. You have debt at the highest it's ever been in the country's history, so something's going to give. So Pedro, I want to bring you into the conversation of, what are some of the best practices, getting early on to it, assuming that some things can potentially happen in managing collections and ensuring that, through the management of those collecting of the AR of the receivables, that you keep that healthy cash flow that we keep talking about.
Yeah, yeah. There's a couple of things. So from the budgeting perspective, there is a line item that famously gets a lot of attention, and board members sometimes don't understand or disregard it, and it's called the bad debt allowance. I'll give a quick explanation. It's not an actual expense. You're never going to write a check for it, but it's the amount that you would say you're likely not to receive from current delinquent owners. And you want to put that as an expense to really balance out your cash flow. If you're expecting to receive $10,000 a month from your budget, you should receive $10,000 a month, even after certain people don't pay. So you want to have an allowance for that. That's from the budgeting perspective. From a tactical sort of collections perspective in your operation, whether you're on site or you're working with a management company, self-managed or not, you need to start with a really good roster of your residents. That includes owners and tenants. That means emails, phone numbers, all of that, because that's going to help in the outgoing communication about where the letters are going to, where the notices are being sent to for collections, or even just general communications. Lastly, I think there is a fundamental sort of cultural thing that needs to be addressed. Very often we deal with a situation where a neighbor gets a collection letter and they knock on the board member's door. Could you believe how offended am I that I received a collection notice? Mind you, they would have only received the notice if they actually did not pay. But the board member calls and says, well, can you do something for him, waive the late fees, and so on and so forth. And that encourages a circumvention of the collection policy. That's sort of a corrosive thing where you're really rewarding the bad behavior. And neighbors catch on to that. Well, if you talk to so-and-so, they'll help you out. And it's that mommy and daddy effect that shouldn't be happening. We should all be working in partnership towards a consistent policy that's well executed and well enforced. Lastly, really, it boils down to, again, back to the partners. You need to have a strong partnership with your attorney. You need to know that the steps they're going to take, you need to know that they're going to take it on time, and what their requirements are in the office. Some attorney firms have different requirements to get a file or a collection file started. But it's important for the board to really understand where it sits, where it really feels comfortable with the collection policy, and that it's compliant. So its management company and its attorney partner can really move forward on it in a consistent way. It doesn't have to be unprofessional. It doesn't have to be aggressive. It just has to be consistent, professional, and respectful communication on a regular basis, so the owner knows how much they owe, how to pay, and what the consequences are if they don't.
Yeah, I think the key what you said there is the consistency is what's most important. And again, I think you've mentioned it a couple times throughout our conversation and throughout the webinar, partnership. And like, I know we tell our clients, no one's perfect, right? So it's not about a pointing of a finger of you did this, you did that. We're supposed to be working as a team. So as a board, you have a responsibility to your homeowners and to the residents that the collection processes are being followed. So check and review your accounts receivable. If you don't see the late notice, final notice, whatever it means, ping your management team. If you're self-managed, ping your accounting team. Or vice versa. If you see your team sending out the late notices when they need to be sent out, late final notices, don't beat them up because one or two residents said, as Pedro said earlier, that why am I getting this? I'm offended. They're following their steps and their protocols. So I agree with you, Pedro. I think that partnership does need to go both ways. No one is perfect. There's no one does everything exactly. Now that you put processes and systems in place, But even with that, you're trying to hit those at, anywhere between 80 to 95% of the time. So as you stated, I think it's important to work in that partnership. And before we wrap up, I'm just curious to see, I put a poll out here. If everyone could take a moment and fill it out and just let us know. I'm interested to see, what percentage increases you're seeing in your budgets in this coming year. What are you proposing? Because I know for us, it's been all over the place. For HOAs, we're seeing anywhere between 10 to 15%. For some condos, we've seen a significant percent, probably in some cases over 100%, just because they didn't have. So if you don't mind submitting, you should see it on your screen. Just submit the poll. We have one here that said 15%. And so we could get an idea of roughly where we're at. So while we have that poll going on, Pedro, why don't we say some final words of, about Affinity, about yourself, and how they can reach you?
Absolutely. So we, right now, we're excited about what's happening in the market. We are seeing that there are more and more self-managed properties that are seeing the value of professional management. With all the compliance in place that's required, it is putting some clients with the realization that they do need that professional help and that professional backbone to kind of help them out. So at Affinity, we very much have a culture that's driven by the values. Very often people talk about corporate values and it's almost like a poster board, but that's really honestly built into the DNA of our culture and what we do. We're very much solutions driven, and we're always looking to find something that works for the client. So within our DNA, we're all about that, what I talked about earlier, which is the align, execute, and deliver. So get on the same page with the client, really move strong and hard on what that solution looks like, and deliver results that are usually guaranteed, so that they know that we have skin in the game. I noticed part of our attendees, we actually have a few of our Affinity team members, so I appreciate that. We have Lauren and Chris, our business development executives, and anybody on the call that wants to reach out to them, they're more than happy to provide very helpful information, very detailed information about how we can help them. More importantly, we're all about educating the marketplace, the clients, whether or not they work with us. If you go to our website, you can see a multitude of videos, educational videos, our YouTube channel, where you can get free information, not just about Affinity, but about really what it means to run an association. I do appreciate the time to be on this, and I hope everybody got something valuable out of it. And we hope to hear from you if you do need help with anything.
Great. Well, it was great having you on. I know the team has been wanting you on for a while, so we're glad that we finally got you on. For those that don't know, Pedro normally works really behind the scenes. I'm more in front of the scenes, so we're happy to have you on, Pedro. And I guess Marc had some technical issues, so I'll wrap up for Marc. So Marc Landes is with Hafer, sorry. Please reach out to us if you want to contact them. We've done great work with them. We work very well together. I can tell you that Marc is on top of his game. What's great about Marc is that Marc has actually worked in our space, in the community association management space. So he understands it from both sides, from both a board member perspective as well as from the audit perspective. So great individual, great firm. So make sure you reach out to them if you haven't signed your engagements already. To all our team members that are here today, again, thank you, as Pedro said, for being with us. Most importantly, our clients as well. I did see some of our clients. And for those of you who have been watching our webinars, you know what I always like to say and how I wrap up these webinars. We're very grateful for the time that you take to be here with us. For both the managers and the board members, we understand that this is a very challenging industry, but ultimately the steps that you take to improve yourself, to continue to grow, really speak to your leadership and the approach that you're taking to better serve your community in either a board member capacity or a manager capacity. So thank you all for being here. I do want to take a moment also to really wish everyone a happy Thanksgiving. I know we're coming up on the holidays, and this will be our last webinar for this month. So wishing everyone healthy and amazing Thanksgiving with your family members. Thank you all for being here with us, and I'll see you at the next webinar.
Thank you.